with ETF.com on the sidelines of the Inside ETFs conference in Hollywood, Florida. And I'm joined here with Robert Nestor, who's the managing director at BlackRock. Welcome, Robert.
Thank you, Smeet.
We're going to be on a panel actually tomorrow, and I'm going to be moderating. We're going to be talking about an interesting topic, which is hedging downside risk in financial markets. I think it's interesting because when you look at the markets today, every day it's going up. I think the S&P 500 is already up 5-6% on a year-to-date basis, and we're not even through January yet. So it's kind of interesting. Should investors even be paying attention to how to hedge downside risk in these unprecedented times? I think the VIX hit a record low last year, 8.56. I think we're in a record streak without the S&P 500 having a 3% or a 5% correction. So are we in this new low paradigm environment that's going to last on and on, or is downside going to come back into the markets?
Well, a couple of points. I think one is how you determine to think about risk or hedging downside risk depends a lot on a lot of different things, including your holding period, what you're comfortable with, and what potential volatility you can absorb at any point in time in the markets. Yes, it's been a period of very low volatility in the markets, and actually low volatility is the norm when you look at it sort of historically, but periods of volatility will inevitably return. So in our view, it's thinking about what kind of risks are you comfortable with taking? I think understanding the risks in your portfolio, things such as factor risk in the portfolios, which I think investors need to do more to sort of broadly understand, and we will be a big part of that. But hedging downside risk really comes back to sort of what's your comfort level in certain situations in the market that investors inevitably will see again.
So it's fair to say that this tranquil period isn't going to last. We're going to see a sell-off again eventually in the market.
Yeah, the environment has been incredibly low volatility of late. Lower volatility is actually, if you look at it over history, actually happens far more often than high volatility, or as most people think about what high volatility is. High volatility generally comes with economic uncertainty, and we've been in a period of confidence in the economics on a global basis and a regional basis for a long time. What's different now is it's exceptionally low. Volatility could double from here and still be well within market averages of roughly 10%. So it will definitely come back. The problem with hedging is you don't know when. And so really thinking about all those risks in the portfolio are critical to figuring out what kind of strategy you want to deploy.
So that's a good point. You just don't know when it's going to come back. So because of that, how should investors position their portfolio? Should they be overweight, underweight certain sectors, geographies? Should they be using options, volatility, ETFs, or even gold? A lot of people talk about as a hedge. What do you think?
Yeah, I think there's a lot of tools at investors' disposal. Certainly there's different asset classes that we like better than others with a 12 to 18 month outlook. But I think the challenge for investors is the real ability to avoid all of that. You're just not going to do it when it comes back. So it really comes down to sort of understanding what risks you are comfortable with and what you're not comfortable with. We talk a lot about, in our world, minimum volatility strategies, which typically give you a profile of roughly market returns over the longer term with about 70 to 80% of the risk. And they're really focused on participating less in the downs, giving up some of the upside in market rallies like we've seen over the last 18 months particularly, while protecting to a great degree on the downside, sort of an asymmetric upside-downside risk. And for a lot of investors, that is the comfort they want. They want a smoother ride. You can have sort of more explicit hedging, as most people think about it, with options and the likes. The problem with them is they can be prohibitively expensive. That is okay as long as you understand that. But it's really about understanding the risk profile you want to achieve.
And before I let you go and ask you another interesting topic, I think over the last decade, 2000 to 2010 or so, we had these two monster sell-offs in the stock market. The S&P 500 fell something like 50%, which is the opposite of what we're seeing today, of course. So were those sell-offs unusual? Can we expect another black swan sometime this decade, next decade? And if so, how should investors hedge their portfolios for that kind of outsized decline.
Sell-offs like that are much more unusual. I mean, sell-offs of 5% typically happen 3 times a year, although it's been over 400 days since the S&P 500 had a 5% sell-off. 10% generally happens once a year, and 20% every 3 to 4 years. 50% sell-offs are far more rare, and as such, protecting against 50% sell-offs can be prohibitively expensive. I think investors need to ask, what will they do if a 20% sell-off happens? Because the biggest risk to investors is that they get out of the market at the exact wrong time. So if they just cannot stomach a pretty significant sell-off, call it 20 to 30%, then tools like hedging, like options and the likes, may make sense if that will keep them in the markets over the longer term. But the only thing we're sure of, the only thing we can be confident of, is markets go up over the longer term. So if you want protection against those very large sell-offs, they can be done. But investors should just understand that they are typically pretty expensive to be able to do that.
Well, a lot of great information, Robert. Thanks so much for joining us. Really looking forward to our panel tomorrow.
Thanks for having me, Sumit.